Olix Network 18, Mission Poshan, Bhavishya Roshan.
Let's get you that promised exclusive. Lata caught up with Chetan Ahya, who, of course, tracks global economies at Morgan Stanley. And this was on the sidelines of the Morgan Stanley Investor Summit. She asked him about what he thinks of global growth at the moment and whether he is expecting a rate hike from the RBI today.
There are challenges. You are seeing problems in terms of central banks tightening in DM, and so that's going to be definitely some kind of a challenge for growth to continue. But to the extent to which this cycle has been driven by capex and productivity, which has really happened for the first time after the deceleration in capex that we saw since 2012. And so to that extent, it is on a much stronger footing. It takes a lot for a capex-driven cycle to be turned down by the challenges that we are seeing right now.
You know, some of the things that keep that are brought to us as red flags. One is that even in the U.S., the difference between the 10-year yield and the 2-year yield is now, it's almost leading to a flattening curve, and so is there a recession? Fears like these are unfounded, you think?
So actually, I think the comparison on that front would be 90s, when yield curve was flattening, and it was relatively around 50 to 75 basis for a long period of time. And guess what was similar to this cycle? Capex was strong. So if you have productivity-driven, capex-driven growth, then the economy can withstand higher interest rates and does not have a problem then.
Okay. So what about EMs then? Do you think they benefit from this? Or, lately, look at the outlier. Maybe these are only outliers, Turkey, Argentina, but even Indonesia had to raise interest rates. So is there a fear of, dollars moving away from emerging markets?
So look, Lata, the way we approach EM's outlook is that we need to first see how their own policy mixes and macro stability indicators are, and then you evaluate that in the context of rise in interest rates in the US. Now, and in that context, taper tantrum and commodity price fall in 2014-15, we think were the triggers. The reality was that these guys were misallocating. So now when we take all the large EMs, bulk of them are doing fine on policy mix and therefore on macro stability indicators.
What's your sense about the Indian financial conditions? Do you think that, are you expecting 1, 2 rate hikes and one today itself?
No, we don't expect the central bank to hike today. Of course, there's always a possibility. But I think looking at the fact that the underlying inflation trend in India is fine, and ultimately that has been the framework that the central bank has provided us. So looking at the trend in inflation, particularly food inflation, which is a big component, it doesn't worry us that the underlying inflation trend is quite okay. On our forecast, we expect the core inflation in India to be going to around 4.3% by March 19. So we think that the trajectory is looking comfortable with the facts that we have. But if you do see a big problem on oil and oil shoots up in a short span of time, then there will be that inflation pressure which the central bank will have to consider. Okay. But I think with the facts that we have, we think they should probably hold today, sound a bit more hawkish and say that, look, that easy monetary policy condition that we had so far is done, and one should be prepared for interest rate hikes in future. Okay,
so a hawkish pause would be more like it today.
Correct.
But for 2018, what are you expecting in terms of rate increases from the Reserve Bank? Will it come in August? Will there be more?
So we see one base case rate hike in last quarter, but we do appreciate the fact that oil prices have moved a bit higher than what we were building in our forecast. And so there is a risk that they could do a rate hike in August.
Okay. Oh, in August. But you only expect one and done?
No, we're expecting 2 more. So in all 3 hikes in our forecast horizon. So it will be a shallow rate hike cycle. Unless you see a big misallocation or redistribution by the government before election, which then brews up inflation in 2009.
What's your sense? Is the rupee appreciating too much, and therefore a rate hike can actually hurt? In real effective exchange rate terms, just about before this current bout of depreciation, we were overvalued by 21% at the end of last year. Now I think it's come down to whatever, 15% or 16% overvaluation. So, what's the sense you're getting in the rupee itself?
So look, I think the fundamental valuation of the currency that we look at would be in conjunction with terms of trade. You can't just look at real effective exchange rate and versus trend and say it's overvalued. So we think currency is relatively fairly valued on that metric if you consider terms of trade in the background. And the other evidence is that the trailing current account balances have been fine. So that's also telling you that the underlying valuation of the rupee is fine. And so I think the two variables which we need to consider. First is what happens to the dollar. We always look at rupee in isolation. Everybody asks me, what do you think about the rupee versus the dollar? My counter question is, what do you think is going to happen to euro versus dollar? And so if you see even the recent bout of depreciation, the rupee is actually moved in line with euro, in fact done better than euro.
Yeah,
so
it's much more stable.
it's a function of what happens to the dollar. And as I mentioned earlier, our FX strategy team is forecasting that the dollar will decline.
Okay.
So I think from that perspective, you should have reduced pressures. And then the other thing is what is going to happen to commodity prices, because terms of trade is also another variable. So if commodity prices rise, then it makes sense for the rupee to depreciate and adjust in line with the terms of trade deterioration.